Hi, my name is Cameron Ollar. I'll be doing financial analysis of three separate industries. We're going to be looking at the automotive industry, pharmaceutical industry, and virtual tech industry. For automotive, we're going to take glances at Ford, Toyota, Fiat Chrysler, General Motors, and Honda. But first, we're going to see their trends within the industry currently. We have governments pushing for cleaner and safer transportation. Operational equipment manufacturers are developing new value propositions to meet shifting mobility needs. This means that developing countries are becoming more urbanized and leading people to search for transportation alternatives. We also have new players entering the field. Some of these people are non-automotive. They are providing services that are car sharing, mobility integration, and usage-based insurance. Social media has been redefining the automotive marketing industry. Consumers are hit with this vast amount of knowledge thanks to the internet, and now they can be more selective of what products they're consuming. We also see collaboration among industry stakeholders. Automotive companies are trying to make friends with their suppliers, with the technology companies, and other stakeholders become more integrative. We're also seeing risks from globalization arise currently. Companies are being challenged by this, and they're trying to determine when and how they should expand themselves to compete with the increased level of competition. So the first ratios we're going to be looking at are the liquidity short-term solvency ratios. It's going to be current, quick, and cash. And the two companies I'm going to be primarily focusing on are Toyota and Honda. So as we can see for Toyota, they have a slow but steady increase for their current ratio, showing that it can meet and pay for their current assets. As well as Honda, they are above 1 as well, but they are on a slow decline, but still above what Toyota's at. Looking at the quick ratio, we see they're about level. Toyota's on the decline though, and once again, Toyota's on the incline, Honda's on the decline, and we can say the same thing for their cash ratios. Looking at Ford, they actually have the highest solvency, showing a nice increase from 0.74 in 2012 to 1.2 in 2016, but that's not everything you want whenever you invest in a company. So next we're going to be looking at the amount of leverage and if these companies can afford their debt and their asset efficiency. So first off, looking at Ford, you see that compared to the rest of the businesses, they have quite a bit of debt taken on. But if we take a glance at the times interest earned, they can actually afford it all years except for 2015. So it's really not that big of a deal for them. And then taking a glance at Toyota and Honda, these two businesses by and far are able to cover the debt much more than the rest of the pack. Now we see with their equity multipliers, Toyota and Honda also have the lowest values, meaning that they're taking on the least debt. So that could be a part of the reason why they can afford the debt more than the others. Another important thing to look at is asset efficiency. It's a good sign of proper management. And we see that Toyota has the lowest amount of asset turnover right now. And they're selling the least amount of product. This is important when you're looking at return on assets and return on equity. With Honda, they're not much better than Toyota right now, but it's about the industry average, and we can see that Fiat Chrysler is exceeding the rest of the businesses currently. Next, we're looking at the return on equity, return on assets, and profit margin, but I'm going to touch profit margin first. We see Toyota has the largest profit margin, almost twice as high as General Motors, meaning that even though they're selling the least amount of product, they're able to turn the highest profit off of that product. And this is a big factor on why they have the highest value on their return on assets and a fairly good value on their return on equity. We see that Ford and General Motors has the highest return on equity right now, but that is going to be driven by their equity multiplier, which is driven by debt. When you see return on equity, you want that to be driven by total asset turnover and your profit margin. We see that Toyota has had a nice increase for the past several years, and Honda has kind of been all over, starting with 4.78, increasing to 11, and dropping back down to about 5 this past year. Return on assets, we see a nice increase for Toyota, kind of jumping everywhere again for Honda, but they're ending at 3.32 for this past year. Next, we're going to be looking at the price earnings ratio. which is looking at your price of your stock if you want to buy it now compared to your par value. So we have it's also a predictor of the future value of stock. And there's also the market to book ratio, which is what the market believes your stock is valued at compared to what you paid for it. With Toyota, we see that they are near the industry average, which is about 13. Honda is right at the industry average of 13. Both these companies have decreased the past few years, but they are still in a position that's better than the rest of the pack with them. Looking at the market to book ratio, Toyota is fairly comfortable. They've jumped from 0.9 to 1.4 the past couple of years. Not a big jump, but it's been a move. A slight decrease the past couple of years. And Honda's actually dipped below 1. And when you drop below 1 for your market to book, that's showing that your stock is actually overvalued. You'd rather be undervalued for your stock. So next we're going to be looking at economic value added, as well as a little bit of capital structure. So with economic value, this is going to be a It's going to be, it's used to measure the value of a company that it generates from the funds invested into it. So looking at Ford, you see that it actually has a negative economic value added. Whenever you're looking into a company, you don't exactly want to see that, but it's not the worst thing. We also see their weighted average cost of capital. It's only 4.2, and it's got a strong factor of debt in there. You'd rather see less debt and more driven by equity. Looking at Toyota, their weighted average cost of capital is only 1% better, but if you can see the values, they're only driven by 0.1% of debt compared to Ford's over 2%. They also are below, they also have a negative economic value added, but being with the rest of the industry, only one of these companies is in the positive, and it's one of the newer companies, Fiat Chrysler. With their weighted average cost of capital, they're also at 6.6, and then we have Honda's weighted average cost of capital at 5.3, with barely in the negative for their EVA. And General Motors is a little bit further in the negative with nearly $2,300, and also with the negative EVA spread and a 5.6% weighted average cost of capital. So these are my two favorite industries. I'm trying to break it down by how we should invest in them. So we're looking at the liquidity, asset efficiency, leverage, time to earn ratio, their profitability ratios, and their market values. With all these, we see that their liquidity was about the same, Toyota and Honda. Asset efficiency, Honda definitely had a better one, but among the rest, Toyota was by far the winner. So we're going to look at the return on equity trends as well, and we can kind of see this. On this line right here, this is Toyota, and you see them with a steady increase for the past 5 years. We also see a little bit of an increase for Fiat. We just couldn't get enough value to see where they actually were. And we see that Ford and General Motors are a little bit higher, but they were driven by leverage.